Welcome back to our financial analysis channel. Today is August 21st, 2025, and we will dive into the U.S. stock market, analysis in the trading session that just ended, as well as look at macroeconomic factors, corporate earnings reports, and expert opinions to get a more comprehensive picture of the market. At the moment, if you have been following the market for the past few weeks, you will have seen that investor sentiment has fluctuated quite a bit. Sometimes excited because of expectations that the U.S. Federal Reserve will soon cut interest rates, sometimes cautious when economic data shows a slowdown in consumption and employment. Today's session is a clear demonstration of that indecision, as major indexes fluctuated in opposite directions. Specifically the S&P 500 index had a slight decrease of about 0.27% and is currently reflected in the SPDR, S&P 500 ETF Trust ticker SPY, at a price of around $638 per share. The Nasdaq weakened even more, losing about 0.6% in the tracking index Q. QQ is at around 565. In contrast, the Dow Jones Index inched up slightly, showing that money flows tend to shift to value stocks and are more defensive than continuing to bet on high-tech growth stocks. This is not too surprising when in recent months, the technology group has continuously led the market up, causing valuations to be pushed up quite high, while the macroeconomic context still has many questions. In this session, we saw some prominent growth stocks such as Palantir, Oracle, or Micron under strong selling pressure. But there were also bright spots. Palantir recovered after the early decline and regained its 50-day moving average, which is an important technical signal that helps strengthen the confidence of some long-term investors. Oracle also edged up slightly, while Micron is still under correction pressure. Notably, defensive sectors have performed well. For example, Boston Scientific, Allstate, Sobha Healthcare, and Adtalem all recorded positive signals, reflecting the sheltering sentiment of capital flows in the context of the technology market slowing down. This is consistent with history. When technology group valuations are too high, money flows tend to return to essential sectors, healthcare and insurance. Another highlight of today's session was Meta's announcement to temporarily suspend recruitment in the AI sector, which somewhat disappointed investors when the artificial intelligence story was expected to be the main growth driver for big tech in the coming period. In addition, the market is also waiting for the profit report of Walmart, one of the largest retail corporations in the world. Walmart is often considered a barometer of the health of American consumers, so their upcoming results could significantly affect market expectations. If the report shows that consumer spending remains strong, that would be a positive signal. On the contrary, if the numbers disappoint, it could raise concerns about a slowdown in the U.S. economy in the second half of this year. Beyond the individual stock market, the entire market is also looking ahead to the upcoming important event, the Jackson Hole Conference, where Fed Chairman Jerome Powell will deliver a speech. The market expects the Fed to signal more clearly about the possibility of a rate cut in September. In fact, the minutes of the Fed's most recent meeting show that there is internal division. Some members are still concerned that inflation has not cooled down completely, while others are concerned that the labor market and economic growth are weakening. It is this disagreement that makes the market even more volatile. Because every new statement or economic figure released can change expectations. Globally, the Asian session saw mixed reactions. Many markets rose slightly, but Japan fell 0.6%. This reflected the cautious sentiment of international investors in the face of risks from the U.S., while also being affected by the instability of the Chinese economy. When major economic centers slow down simultaneously, the risk of spillover to the U.S. is inevitable. It is worth noting that many leading experts, including representatives from PIMCO and Unlimited Funds, have warned that the stock market may be masking important economic realities in the United States. In other words, the recent surge in stock prices may be misleading many people into thinking that the economy is healthy, when in fact consumer spending, employment, and industrial production are slowing. If these warnings are correct, the market may need to correct in the near future to more closely reflect economic reality. In addition, we need to talk about valuation. According to Axios analysis, not only big tech, but almost the entire market is at high valuations. This makes it almost impossible to buy cheaply, making it difficult for new investors to find a reasonable entry point. Even the risk of a 5 to 10% correction or more is entirely possible. If there's an unexpected shock from economic data or Fed policy, there are also opinions from the Financial Times that the recent wave of technology stock sell-offs is somewhat exaggerated. There's not really any core factor that is too serious, so investors should not react. However, in general, most opinions agree that caution is needed with the current price level. So what should we do at this stage? If you are a long-term investor, you can consider restructuring your portfolio, reducing the proportion of stocks that have increased too much in the technology group, and allocating more to defensive sectors, such as healthcare, insurance, and consumer staples. This is a way to minimize risks when the market fluctuates. If you are a short-term investor, closely monitoring technical levels, especially weekly charts, will be very important. Many experts advise that when the market trend is unclear, we should not be too greedy, but should keep ourselves flexible, ready to exit when there are bad signals, and patiently wait for new opportunities. In conclusion, the U.S. stock market on August 21, 2025 is a mixed picture. The index is slightly down. The sentiment is cautious. The money flow is shifting from growth to defense. Valuations are high, and the macro factors are still not really supportive. We are in a period where every piece of information, from the Fed, every large corporate profit report, or every economic number released, can change expectations in the blink of an eye. As an investor, the most important thing right now is to stay calm, not let emotions dominate, and build a more balanced portfolio. If you find this video useful, don't forget to subscribe to the channel, and turn on the notification bell so you don't miss the next analysis. Leave a comment to let me know which industry group you want me to analyze in depth in the next videos, for example, technology, healthcare, or energy. I look forward to receiving your comments so that the channel becomes more and more useful. Sharing place for the investor community.